Imagine the Euro-USD climbing steadily. The relative strength index hits 75, signaling overbought. Traders immediately hit sell, anticipating a reversal. But the price rockets higher, liquidating shorts while the RSI flatlines at the top. This is the falling knife trap. The relative strength index calculates the velocity of price changes. In a vertical rally, that velocity remains high, which means the indicator stays pegged at the extreme top, regardless of whether the market is actually ready to turn. During these parabolic runs, an RSI reading above 70 serves as a marker of extreme trend strength. The price is moving with such speed that the mathematical velocity remains high, even as the pair reaches new peaks. Relying on a momentum indicator in isolation ignores the broader market structure. To avoid these traps, traders must anchor short-term velocity to a secondary structural filter. This strategy replaces the 70 and 30 extremes with the 50-level pivot. This equilibrium zone serves as the primary battleground. When RSI holds above 50, bulls control short-term momentum. When it drops below, the bears take advantage. To contextualize this velocity, we add the moving average convergence-divergence. This acts as a lagging, trend-following anchor to ensure short-term momentum aligns with the broader move. Act on a bullish MACD crossover only if the RSI is above its 50 line. A bearish setup requires a downward cross while the RSI remains below 50. If the MACD crosses up but the RSI stays below 50, they conflict. Ignore the trade. This two-step alignment zone filters out the high-frequency noise found in sideways markets, identifying the specific windows where price and momentum are pushing in the same direction. Identifying major trend reversals on the 1-hour and 4-hour charts requires hunting for a Class A divergence, a specific triple alignment of price and indicators. A Class A reversal occurs when price makes a definitive higher high, but both the RSI and MACD simultaneously register lower highs. This simultaneous refusal to follow price indicates a significant decoupling between price action and momentum. This lack of technical support at a new price high suggests that the buying pressure required to sustain the trend is exhausting. It signals that the current move is likely losing the participation of larger market participants. By isolating these Class A divergences on higher timeframes, traders avoid the minor fluctuations of retail sentiment and align with major shifts in institutional flow. Winning trades often evaporate because traders lack a systematic way to identify the exact moment a move exhausts itself. Without objective exit rules, profits are frequently lost to minor retracements. The MACD histogram serves as an early warning system. When bars contract toward the zero line, known as fading, it indicates the move is losing strength despite rising prices. The final signal to close occurs when the RSI crosses back over its 50-line midpoint. These two visual cues provide a mathematical framework for exits, helping traders secure profit before the momentum of the move fully dissipates. While the 14-period RSI is the industry standard, specific market conditions may require strategic tuning. Switching to a 9-period RSI on volatile pairs like gold or GBP-JPY increases sensitivity to recent price action. This provides earlier exhaustion signals, provided the MACD filter remains in place to manage the increased noise. Long-term consistency depends on disciplined confluence, only taking action when multiple technical layers confirm the same market direction. High-probability setups appear when the short-term velocity of the RSI and the medium-term trend of the MACD align with the underlying market structure. Test this noise filter strategy on an FXNX demo account to see how 0.0 pip spreads impact your execution and overall win rate.